now for something completely different.
Forget everything you've been told by others before. Get ready for the real deal, the full story. Real talk about money, markets, life. Now, it's The Real Investment Show, presented by RIA Advisors.
Welcome to The Real Investment Show. I'm Danny Ratliff here with John Penn. Thank you guys for joining us. It's been an extended Thanksgiving vacation. Lance is unfortunately still out in a turkey coma. But we're here. We're going to hold down the fort. Yesterday, as I'm sure some of you may have noticed, had a little power surge here yesterday, a little technical difficulty. So Brent has been pulling his hair out.
It's like MacGyver.
Like MacGyver.
Making it work.
Right, a lot of stuff going on. Been an interesting week. Did see a little bit of sloppiness over the last couple of days, kind of to be expected. Market's been fairly overbought. Have seen rates sit around that 4.4 range. I think we could potentially get a little bit of a rally in rates, which is not good for bondholders, but could be a good buying opportunity if you do believe that this is going to be a spot where rates may not go up all that much. We did get new home sales yesterday, actually down from the median forecast at 725 of 679,000 new homes. Today, we're going to get the S&P Case-Shiller Home Price Index and consumer confidence, and the Fed is going to go on the podium. There are going to be lots of Fed speakers talking, a lot of the governors coming out today. So we will be following closely what exactly they're going to say. I don't expect much to be changed at this moment. I think throughout the rest of the week, we'll hear from probably all of them. GDP first revision tomorrow on Wednesday. And then what the Fed most closely watches, PCE, Personal Consumption Index, or expenditures, is going to be, I think, what everybody's going to be watching. A lot of interesting data coming out. I mean, I don't know if you guys hosted Thanksgiving. We did. And, the price was the second highest Thanksgiving dinner on record. And, everybody says second highest. I mean, we've had inflation. Everything's been extremely expensive. But last year was $3 more if you're hosting. So, and most people were putting that on credit cards.
Credit cards, yeah.
It's crazy. So, we keep talking about potentially the consumer running out of runway here when it comes to credit, but they're finding more and more ways. In fact, looking at holiday spending trends, it says 36% of people anticipate spending more this holiday season than last, and that festive meals will be one of the biggest expenses. Of Americans who intend to host Thanksgiving, 58% anticipate using credit cards and accumulating debt just to cover the cost. 51% of respondents in the survey expect to spend $750 or more on gifts, while the big payment is going to be through credit cards. Mm-hmm. And we've also seen a big increase, which Lance has been talking about. He and I have been bantering. I don't understand how the consumer can continue to spend with the amount of credit card debt that we have. It crept up from $1.03 trillion to $1.08. I mean, we're talking about an enormous amount of debt out there. And 40% of the respondents said they're electing to use the buy now, pay later method. And, that's quite a bit. And you have to think at some point, if people are using that, what are the reasons why? I mean, maybe they are too overextended on credit cards, so they're using this, or it's just another method to not put it on the credit card and not pay any interest, which, hey, I'm a big fan of. But also, I think our rule is if you can't pay it off, don't put it on. So, we're going to be watching this data. I think right now the market is really trying to hang on every little word that's coming out, essentially from the Fed, but also from, what are the retail numbers really look like? Is the consumer much stronger than we anticipate in this season? And, at what point do we actually see them run out of runway? Right now, it seems like there's a lot of road in front of them. Mm-hmm. I don't know, what did you guys host Thanksgiving? Have you seen?
We went to the chaos this year.
Yeah, okay.
So we went to one of Shauna's sister's houses. We went there for Thanksgiving, but the chaos is coming. We're going to host for Christmas.
Okay.
So everybody's coming here. So if y'all all need a place to come on.
Heck yeah.
Come on, right? But so hopefully the house will still be standing. But yeah, we're going to be hosting for Christmas. But you were talking about the kind of the buy now, pay later, and PayPal is a very common tool that's used through that. If PayPal's used correctly, it can work very well, right? But the issue is if you don't pay off your your PayPal. I think they give you, what is that? Is it 6 months of with no? Yeah, if you're able to pay off your balance through PayPal within 6 months, you can pay that off without interest. But if you go over 6 months, then you're charged. I think it's 28%, 28.24% on that balance. I mean, yikes.
Well, the problem is that once that balance starts accumulating that interest, it is so tough to pay it off. You're just paying down little by little typically, and that's where we see people get in so much trouble. We hosted this year, and ours was much more expensive because my daughter said, "Hey, will you take the turkey out and put it in the fridge?"
Okay.
Went, ran some errands. Turkey's not in the fridge. Turkey's on the counter at room temperature. A day later, I'm like, oh shoot. So a little more costly than anticipated, but
Little salmonella turkey
it was a little learning lesson. Luckily, it was trash day the next day, so we were able to get it out in time and go get another turkey to continue the festivities. But yeah, no, and so it is interesting. The survey's coming out or they're suggesting that things were cheaper. I know most people we talk to, especially we're seeing inflation numbers that have crept down, but everybody's like, hey, I'm going to the grocery store. Nothing is actually cheaper. I was like, well, that's right. We don't have deflation right now. We have disinflation, where we see inflation is coming down from these much higher numbers, but it's still increasing year over year from those higher numbers. And so I think that's what's been difficult for many people is that, we haven't actually seen that big price cut like we've been hoping for, or I think many have. But, that doesn't come with necessarily great things either, because if we are seeing that, we're potentially going to see other issues. Walmart came out 2 weeks ago with their earnings. They suggested, hey, we could potentially see deflation. Well, we'll see price cuts. And so we started thinking about that. So, okay, what does that mean? If companies are going to start cutting prices, what else are they going to cut probably before that? Probably staff. And so people. And so I think you have the two P's, people and prices. And unfortunately, people probably become before prices, which will become problematic for the broader economy if that does come to fruition. We're hearing more and more about a soft landing. And, I was listening to some things this morning on the way in, and that seems to be the rhetoric that's out there. And if you look at earnings estimates or even estimates just on the S&P 500, a lot of big analysts have come out and said, listen, 2024 is, you get both sides of it, but a lot of them say, look, it's going to be choppy. Fixed income is going to be a great place to be. I think there's a 74 CME forecast has a 74% chance of a rate cut by June. So that's a pretty big high conviction, at least for the moment. Now that can change very, very quickly. And the dynamics that we're faced with right now make it challenging, because if you have this great economic data, what is the Fed likely to do? They do either do nothing at all, right? You see rates creep back up, or if they don't, they'll probably have to hike again at some point. And that's what makes this so challenging, because then on the other end of this is that you get poor economic data. Does that actually get you to a soft landing if it's not too bad? And we can muddle our way through this. That's what I think is going to be the biggest challenge here, is how do these companies continue to grow earnings? How do we continue to see the consumer demand still there? At some point, you think that would all have to weigh on the economy. And listen, the narrative for the cons seem to be so much easier, and just talking to different people, John, I know you see and hear this, than what the pros are. And sometimes it is very difficult to rationalize something that may be irrational. And the markets can remain much more irrational than we can remain rational. So we've got to be very disciplined as far as how we invest, what we do. Follow the technicals. Look, we expect to see a little bit of a pullback. We're getting into this December where we'll see mutual fund capital gain distributions. This is something that's not uncommon to see a little bit of a pullback. Market's already at an elevated spot after 3 months of negative market returns. We had 4 weeks that were great. And I think it's easy to forget about August, September, and October. But keep your eye on what's going on, understand it, and not a bad time maybe to pare down a little bit if necessary. But we'll get back to this and more on the other side of this. Thanks for listening. You're listening to Real Investment Show.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
The Real Investment Show YouTube page has all of our videos ready for your easy access. From 3 minutes on markets and money to each day's radio shows like Technically Speaking Tuesday, Financial Fitness Friday, and the latest analysis from Lance Roberts and Michael Leibowitz. Subscribe and bookmark our YouTube channel for The Real Investment Show. Or just click on the show links at realinvestmentadvice.com.
Hi, Lance Roberts here. If you're like most people, your 401k plan represents the bulk of your retirement assets. And unfortunately for many, managing your 401k plan can be difficult. There's so many choices, so many things to consider. With just a quick email, a couple of questions, you can put RIA advisors to work for you managing your 401k plan. Get started right now at the website, realinvestmentadvice.com, or simply call our toll-free number, 855-RIA-PLAN, or again, simply online at realinvestmentadvice.com.
Small businesses are discovering that attracting and retaining top talent come down to more than just salary. In today's highly competitive job market, compensation is more than just wages. Hi, I'm Tom Allen, RIA Advisors Retirement Plan Consultant. Healthcare and retirement plans can make the difference in hiring and retaining the best employees. We can show you how to build an affordable, effective employment package that delivers true value for your workers and your business. Call me toll-free at 855-RIA-PLAN or online at realinvestmentadvice.com.
And now, another page from the Real Investment Advisors Investing Manifesto. Bulls win in bull markets. Bears win in bear markets. Eagles soar above and take advantage of opportunity. Let us help you soar as you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
The Real Investment Show.
Everybody will kind of bring their own dish, so that we'll kind of spread the cost around a little bit. We'll still.
Welcome back to the Real Investment Show. I'm Danny Ratliff here with Jonathan Penn. John
Hey, everybody.
John's sharing his ideas on the less chaotic holiday season. And I do like what you just said. I mean, kind of spreading the love a little bit, having everybody do a little bit of something to kind of help ease the burden.
It does.
At our house, Michelle decided to start cooking on like Sunday or Monday, like trying new recipes. And she's always trying to eat things really healthy. So she's always trying to find a way to, I'm not going to say cut corners because it makes it a little more difficult, but find ways to make food still edible and healthy. and there's some she does a really, really good job. But there are a couple things I'm like, I don't think it's going to make the cut. It was a good thing you started this several days early on that. Then she wonders why she's so tired. I'm like, well, I mean, you kind of did this to yourself.
You have an example of what didn't make the cut?
There were some cookies.
Oh.
That's the problem, right? If you try to do these cookies that, are really, I'm calling them kind of hippie. Sorry, babe, if you're listening.
Hippie cookies?
Hippie
Well,
cookies.
it's just, that you want to take all these things out of it. And
Were they
they're just not nearly as good.
organic?
I don't know, Brent.
Are they earthy?
They were cardboardy.
They're cookies made with cardboard.
Yeah, it was pretty bad. What else? There was a couple iterations of pies.
Yeah.
Trying to think what else. We had a green bean casserole that maybe shouldn't have made the cut.
Ooh, and I like when green bean casserole's right. That's some good stuff.
It was
right
actually
there.
pretty good. In her defense, it was pretty good. But she's not buying the store-bought gravy. She's doing everything the hard way.
Yeah.
No easy road at the Ratliff household. It's not possible.
Yeah, so we were lucky that we went over to Shauna's family, so everybody kind of brought their own dish, right? But then and I look, I'm a leftover guy.
Yep.
And so the issue is when we went over there, we didn't have any leftovers.
Oh,
So,
yeah.
but at least for Christmas, we're hosting for Christmas, right? So at least we'll have some leftovers that I can kind of eat on for a couple days.
So we did have leftovers, and the funny thing is, like, I'm the only one who wants to eat them. I'm like, no, we're not going to the. What, you kidding me? We're not going to the store. We're not going out to eat. We've got a couple days left of this. We're going to be fine. So you turn turkey into do a turkey and sausage gumbo. You can do so many different things with it. Nice having a little bit cooler weather down here in Texas. We don't always get that, so certainly something we're taking advantage of. So we get a lot of questions, John, and I think end of year, everybody wants to kind of check off the checklist, make sure they're dotting their I's, crossing their T's, and we'll probably get that either later today or tomorrow. But a lot of things that are going on right now, and I think a lot of questions because we are hearing the negative narratives. And one thing, I just mentioned last segment a little bit about how you have some of the big firms coming out with estimates for S&P next year. Some of them are rather flat. Some of them are a little bit more bullish than others. We don't really have a ton of bearishness, except for at least not with the big wirehouses and big banks. But last year, all these same people came out and said the first half of the year is going to be terrible. The second half of the year, we're going to have a recession priced in, and the second half is going to be great. We had one of the best Januaries on record, and next thing you know, everybody changed their tune very, very quickly. Now they came out and said, whoa, first half is going to be great, and then the second half is going to be rough. Well, pretty easy to do that when you're looking in the rearview mirror. The only reason I bring this up is to give you a little context that we have to be extremely cautious with any of this information that you get because it is so subject to change. And it can change very quickly, just like we saw with the Fed going from not hiking to boom, fastest rate hiking campaign they've ever been on. That is something that, we have to be aware of. Economic conditions change quickly. Policies change along with it. And, we're going to see a lot of different things occur. And, if we had a playbook and we could say, hey, here's a game plan. Here's how we're going to run this. You're going to have to be ready to call an audible, make a change, right? If this is a football game and you're at the line of scrimmage, you're going to have to be prepared to say, whoa, defense changed here. We're going to have to change what we're doing a little bit. And, we don't want to do so in a way that you make knee-jerk reactions because I think that's where many, many people get in trouble. But, John, you get a lot of questions. And so one big one is still, what do you do with excess cash? Mm-hmm. And so for somebody who maybe has a lot of money sitting in a checking, a savings account that's sitting around, maybe you've just been accumulating funds over the years, or you've been saying, hey, I don't trust the markets. I don't know what to do, or I don't trust myself dealing with the markets. We hear a lot of that as well. What do you tell somebody?
Well, I think it all comes down to, ultimately, what do you need that money to do longer term, or are there some short-term needs, or do you have some short-term expenditures for that cash, right? I mean, if you're paying college tuition, or if you've got that money set aside for property taxes, it's probably better just to kind of keep that where it is, just earn a higher rate of return right now. At least you can kind of reap the rewards of the Fed being aggressive with raising short-term interest rates. You're for the first time in a long time, you're getting more attractive rates of return on that cash. But I know with you and Rich on the show on a regular basis, Danny, you guys always talk about making sure you have that financial vulnerability cushion, have that emergency fund set aside. So and that number can kind of vary for everybody. Sometimes folks like to keep at least 6 months worth of expenses set aside in savings. Sometimes it's a year. Maybe it's 2 to 3 years of income or expenses that you have set aside. So that way, if we do hit some more volatile times in the market, you have some flexibility where you have that cash to pull from, and it allows that you give markets that time to recover, so you're not being forced to sell securities potentially when they're in a loss position to raise that cash that you need for your living expenses. But I would say is it really comes down first looking at what are your expenses, look at your budget, let's figure out what it costs you to live and run your household every year, and then you set aside whether if it's 6 months, 1 year, 2, 3 years worth of expenses off to the side. Then the rest that you have that's left over, then we can look at, okay, do we want to be a little bit more longer term with this? Do we want to be a little bit more growth oriented with this, with a more actively managed portfolio? And some of that money that you have set aside in there, do you keep for those emergency funds? Do you just keep it all in a money market, or maybe you keep a year's worth of liquid funds in that money market that you can pull from, but put years 2 and 3, ladder into some short-term treasuries right now. Take advantage of the higher yields. In addition to being a little bit longer term with that money, growth-oriented portfolio, do you participate in a high-deductible health plan? Have you funded your HSA this year? Let's look at, are you maximizing all of the retirement savings vehicles that you have that you can use to your advantage? So and I'm rambling off a little bit here, but sometimes it's not a clear-cut, simple answer. It really kind of depends on your budget and what your expenses are, and then we kind of go from there.
Yeah, no, and I think that's a great point. Everybody's going to be a little bit different, and it's really going to be what the objective is, what the funds are intended to be used for. Visited with somebody yesterday. We had baseball practice. He had a rate sheet from a large private bank. And I thought this was really interesting. We kind of looked at it together, and it was basically CDs, CD ladders from a large institution. And the rates were actually pretty good, 1 year and less, 2 year. At about the 2 year mark, they just fell off a cliff. And I mean, it was like, man, I don't know why you would do that. Because especially when you can go out and buy a 5 year treasury at 4.41, a 10 year at 4.41. And then they were issuing CDs at 2.5% or less. And so, this is another thing that you have to be cautious with. Everybody wants to play the game of, I want to get as much as I can right now. And I get it. I'm with you. I think we all want that. The problem is we have to think forward and say, what exactly happens? And if these institutions, so what that tells me, this institution believes that rates will be lower in the future. They'd rather pay us more now, and that way they can pay us less later. And so they're incentivizing us to go on the short end of this so that all of us put this money into something to get a short term, it's a 3 month, a 6 month, a 9, a 12, whatever it may be. And then when those funds roll at some point in the not so distant future, you're going to be stuck with that reinvestment risk. And that's what concerns me about, the short term end of it. And I like it. Listen, if it's for something like, hey, I've got a tax bill coming up, I have, like you mentioned, had to pay for college, had to pay for, school, whatever it may be. You need a new vehicle. I think this is a great tool. Use it to your advantage while you can. But they're telling us that they think rates are going to be lower. Janet Yellen, 3-4 weeks ago, reissue some new debt. A lot of times when debt comes off the books, they'll essentially reissue it in the same term. Almost everything was really short. And I thought about this. We've talked about this a little bit, John. It's like, okay, well, that gives us a little bit of conviction to our thinking as well that rates will inevitably come down. It's smart. They'll pay a little bit more for the shorter period of time. Later, they're going to be saying, hey, we'll just reissue it for long term for much cheaper rates. But then again, I was like, oh, crap. It's just Janet Yellen. And
where's Rich when you need him? We need a Janet Yellen impersonation.
Well, that's why we can talk about her.
That's true. That is true. Yeah.
Yeah. So just something to keep in mind with this. But everything you said, I think you hit the nail on the head, John. I mean, it's important to understand exactly what these funds are to be used for, what your time frame is for this, and, what is the overall big picture. Some people are just using it as a short-term place to store funds because they think that the world is going to fall apart and things will be much cheaper. And that's one thing you can do. But I caution you on this is that a lot of times it doesn't happen the way that you think it will. Kind of like this year. This year's been a difficult, challenging year for many. Everyone, really, anybody that's invested in a somewhat diversified portfolio, you've struggled. Now we've seen better market participation over the last month, but for 10 months of the year, it's been a challenge unless you were just strictly in tech. But we're going to talk more about some of the bigger ticket items and what do you do with excess cash. We get right back on the other side of this break. You're listening to The Real Investment Show.
It's rock and roll. 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 It's rock and roll.
The Real Investment Advice blog. It's required reading for the informed investor. Catch it today at realinvestmentadvice.com.
Oh, Red, I declare, I plumb missed that candy coffee. Whatever am I gonna do?
Don't you worry, little darling. We'll watch it again on our YouTube channel.
Why, Red, I never.
The Real Investment Show YouTube channel has all of our past presentations, from Candid Coffee and Lunch and Learn to special topic discussions, and all of our live show recordings preserved for you. Subscribe now to the Real Investment Show YouTube channel, or look for the link on our website at realinvestmentadvice.com.
Health and financial security touches everyone within your organization. Offering benefits for all doesn't need to be complicated. Hi, I'm Tom Allen, Senior Benefits Consultant at RIA Advisors. RIA Benefits provides independent expertise to find solutions that speak to the mission of your business, the culture you want to establish, and the budget you are able to work within. Book a free consultation with me at realinvestmentadvice.com/retirement, and we'll find a solution that takes care of your most important asset, your people. realinvestmentadvice.com/retirement, realinvestmentadvice.com.
You can get daily real investment news you can use, delivered at the speed of the internet. Sign up for Lance's newsletter now at realinvestmentadvice.com.
In 1999, a parafiduciary group of financial advisors were busted by corporate giants for trying to operate in their clients' best interest. These men promptly escaped from a high-cost margin environment to the Houston Energy Corridor. Today, still excoriated by their former employers, they survive as protectors of others' fortunes. If you have a problem about preserving capital, if no one else can help, and you can find them right here, maybe you should hire the RIA team.
Can't catch the whole show now? Listen to our podcast later at realinvestmentadvice.com.
You know, my kids are at the age now where they still send Christmas lists, and my wife and I just laugh. She and my two daughters, they want a pair of Ugg slippers, and you can't get them.
The Real Investment Show podcast. Same show, your schedule.
These Uggs, you cannot get them anywhere. It's like, well, you're going to get the knockoff brand.
Instead of Uggs, you get Oops.
You get Oops. Exactly.
At realinvestmentadvice.com.
You get what they're actually called, Uglies.
And now, another page from the Real Investment Advisors Investing Manifesto. Manage risk and volatility rather than trying to manage gains. You don't have to be right all the time. Long-term investing success is a 70% gain. Let us help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
Real Investment Show podcasts are now available on iTunes. Listen anyplace, anytime at iTunes.com.
Hi, Lance Roberts here. If you're like most people, your 401k plan represents the bulk of your retirement assets, and unfortunately for many, managing your 401k plan can be difficult. There's so many choices, so many things to consider. With just a quick email, a couple of questions, you can put RIA Advisors to work for you managing your 401k plan. It's a quick and easy application. Just simply click Ask a Question at realinvestmentadvice.com or give us a call at 855-RIA-PLAN. That's realinvestmentadvice.com.
The Real Investment Show YouTube channel has all our videos ready for your easy access. Now, with the new and improved Before the Bell report. Subscribe and bookmark our YouTube channel at realinvestmentadvice.com.
You're listening to The Real Investment Show.
Welcome back to the Real Investment Show. I'm Danny Ratliff here with John Penn. So if you've not done this already, go to our YouTube channel and go look up the Real Investment Show. Go subscribe. Always lots of good banter there. And if you miss a show or you're in the car, it's always an easy way to go back and listen. So I did make mention, evidently we got a lot of deadheads on the YouTube channel because I mentioned Hippie cookies, and I was mentioning like maybe taking some gluten out or sugar, not what you guys were thinking. So,
Healthy.
Healthy. There you go. Yeah. It's like, whoa, okay, hang on now.
Somebody said they had the healthy cookies one time, hippie cookies one time, and they got the munchies after.
So they just ate more.
That was the ingredient.
All right. So we've talked a lot about what to do with excess cash, and this is something that I feel like is a topic that we cannot cover enough because we continuously get a lot of questions. So one thing, if you do have a question, you can always go to realinvestmentadvice.com, go to the Ask a Question. Lance is really good about answering those and doing so very quickly, typically. But, so talked a little bit about the yield curve, John. Maybe give a little bit better description because I think sometimes we take it for granted because we talk about it so often. And listen, I know a lot of you out there are really sophisticated. You know exactly what it is, but the average investor may not. Tell us a little bit about just break it down in a quick.
When I think about the yield curve, the best way that I can really describe it, Danny, it's time, right? So kind of think of the yield curve almost like a horizontal axis, like an x-axis, and you have kind of two opposite ends of the yield curve. And when we're talking about the yield curve and talking about time, we're talking about debt instruments or bonds that fall all along the curve. And on one extreme, let's call it the short end of the yield curve, you have debt instruments, or let's say bonds. In this case, let's say treasury bonds that have a short lifespan. Let's say they last for 3 months, 6 months, 9 months, a year, maybe out to 2 years, right? Then you go on the other extreme of the yield curve, let's call it the long end. And out there, that's where bonds have a life of, let's say, 20 years, 30 years, right? And the interest rates that those bonds pay across the yield curve, they move for different reasons. On the short end of the yield curve, those interest rates adjust up or down really by what the Federal Reserve is doing. So as the Fed has been raising short-term interest rates over the last 2 years, you've seen your yields or your interest rates on short-term debt instruments, money market funds, short-term CDs, short-term treasuries. You're getting on short-term treasuries a little bit north of 5%, right? And then with a normal yield curve environment, the yields or the interest rates that short-term bonds pay you should be less than what you are paid on the long end. Because if you think about it, if I'm going to invest in a bond, Danny, if I'm going to put money into a 3-month bond or a 20-year bond, as an investor, if I loan, and a bond is nothing more than a loan, and I know Mike and Lance, they've discussed bonds ad nauseum on the show here, but it is principle, a bond is a loan. If I invest in a bond, I'm basically loaning my money to an entity for a specific period of time, and that entity is going to pay me interest on that bond.
It's an IOU. So it's
an
either,
IOU.
The government, municipality, or a corporation.
You got it. And there's lots of different entities that you can invest in bonds. But you're right, Danny, it's an IOU. But really, you should be, as an investor, if I'm going to put my money into a 10 or a 20 or a 30-year bond, well, that time element, there's more time to allow that entity to maybe default on that IOU back to me, right? So I'm taking more risk if I'm investing in a 10 or a 20 or 30-year bond. Hence, I should be paid more interest on that. Well, right now, because the Fed has been so aggressive with raising short-term interest rates, the yield curve is what they call it's inverted. You're getting paid more from short-term bonds right now than you are on long-term bonds. And it should be the other way around. So when you hear folks talking about the yield curve, it's just time, and how long do those bonds across the curve? How long are they in existence for?
Correct.
Right?
So in a normal economy or a normal environment, you would typically see that the 3, 6, 9, 12 month would be paying less than a 2-year, right? And it typically goes up, but with the inversion, we're seeing the exact opposite, where the very short-term debt is paying more. And so historically, that does signal a recession here at some time in the future. And so just things to, just want to bring that out, especially we're talking about, how people can use excess cash, what you do with it, our concerns over the potential for lower rates in the future, that at that point, that reinvestment risk that we just discussed. So another big question that we get, and I think this is where mainstream financial media does a really poor job with this, is they say, what's your number? And everybody wants to know, like, what is your number? You've seen those commercials where, you got these numbers in the sky and everybody's going around saying, my number's this. And mine's, 2 million, 3 million. And the problem with that, I think, especially for younger folks, is that it makes it extremely difficult to comprehend how you ever get to that number. And so sometimes people just say, forget it. I'm never going to get there. We talk about Rome wasn't built in a day. Neither is your financial security, your nest egg, your retirement. And I think that's really important. And so when somebody asks you that, what do you typically say? Because that seems to be the biggest question. I mean, if I meet anybody on the street and like, oh, you're a financial advisor, what do I need to retire?
Yeah, just what is that sum of money where I can retire comfortably? And the answer is it's so different for everybody. And a lot of it really comes down to just, and again, not to sound like a broken record here, but a lot of it comes down to your expenses and your budget and how much are you spending every year just to, keep your lights on and keep food on the table. What about, what are your other goals? Do you have travel? Are you charitably inclined? Do you have philanthropic needs or desires, or do you want to leave a legacy to your family? And so all of that, all of those various, what we call wants and needs and wishes, they all, lead into just, what amount of money do you really need? And at the end of the day, it's not so much what is your number, and that is important, but it's also what is the rate of return that you really need to earn on these monies that you're setting aside in savings. What is that hurdle rate? What is the rate of return that you need specifically for all this to work? Right?
Over a longer period of time.
Longer periods of time. Not 6 months, not 8 months, but over longer periods of time. What is that rate of return that you need for and what we're really talking about here is a plan. Looking at a financial plan, looking at this big picture, looking at this holistically to really answer that question, right?
Yeah, and I think it's difficult because, when we talk about, the returns over time, we factor in negative, poor returns over different market times and periods. And it's difficult because you may have a time period where maybe you're a little bit under that rate because you had a poor market. Like last year, for example, we had a lot of people that would call in and say, guys, we talked to so-and-so, their plan still worked. My plan doesn't work anymore. And so you'd find out that their advisor was using, 8, 9, 10, 11, 12% returns, which, number one, are probably not always achievable. I mean, year to year, yeah, of course, you can get really good returns. But is that going to be, what does that look like when you get a bad year like you saw in 2022?
Mm-hmm.
It diminishes quite a bit of that. And, so that's where you have to be cautious. The other aspect is I have told people with, $500,000 that they can retire. I've told people with, tens of millions of dollars that they cannot. And so it comes back to what you just said. It's all about the spending. It's all about the longevity. What does that look like for you and your family? How long can these funds go? Do you have a pension? I know those are like dinosaurs. They're extinct at this point, but many people don't, but there's still enough of you out there that do, which can really, really help. Every little bit helps. Do you have rental income? Do you have any other type of income? Are you doing contract work? I mean, all these little things add up, and the longer we work, typically the better the plan works, which, ideally should make common sense. But that is tough. And then I think it's really good to break it down and understand, okay, actually knowing where your funds go. Where are you putting money each and every month? Are you paying yourself first, right? That's the biggest old investment adage. Pay yourself first. Do you actually do that? Where are you putting those funds? We've always talked about a hierarchy of savings, and I think this is really important, especially right now, year end, trying to tie up, making sure before the end of the year that you take advantage of everything you can through your employer, putting funds aside, from a tax advantage or efficient way. And that may not just mean putting everything pre-tax. Everybody wants to save money today, but we've got a looming, tax that's going to change, right? Our taxes are about to change here in 2026, where they revert backwards. Brackets condense, rates go up a tad bit. So you could potentially, you're not always retiring in the same income bracket, or a lower one, actually. More often it's probably the same than it is lower, is what we find. Because when you start taking out, how much you put in on your 401k, what are your other pre-tax expenses, that actually you find, and then what are you saving? You may not be in a much different situation than where you'll be in the future. And I'm sure it's something you see too.
Yeah, I do. We're lucky that we the clients and the individuals and families that we serve, they're all great savers. I mean, they are great savers.
Yeah, no doubt about that.
But there are a lot of folks that are a little older, where maybe the Roth wasn't as prevalent in the past, right? So they have a lot of money in their pre-tax, their 401k, they move it all to their rollover, traditional or rollover IRA. And as they start pulling money out, that's all taxable income. And they go, I just don't understand. Why are my taxes still so high, right?
Yeah, you see a lot of people who that is the only funds they have is in that pre-tax. So that's actually a great segue. When we get back from this break, we're going to talk about the Roth 401k, Roth IRA. What's the proper ways to use them? What are the things that you need to know? So thanks for listening to Real Investment Show. We'll be right back after this break.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
In 1999, a parafiduciary group of financial advisors were busted by corporate giants for trying to operate in their clients' best interest. These men promptly escaped from a high-cost margin environment to the Houston Energy Corridor. Today, still excoriated by their former employers, they survive as protectors of others' fortunes. If you have a problem about preserving capital, if no one else can help, and you can find them right here, maybe you should hire the RIA team.
Hi, Lance Roberts here. If you're like most people, your 401k plan represents the bulk of your retirement assets, and unfortunately for many, managing your 401k plan can be difficult. There's so many choices, so many things to consider. With just a quick email, a couple of questions, you can put RIA advisors to work for you managing your 401k plan. Get started right now at the website, realinvestmentadvice.com, or simply call our toll-free number, 855-RIA-PLAN at realinvestmentadvice.com.
Small businesses are now being challenged by the lack of employees and how to attract and recruit the best employees. To get the better employee, you'll have to offer a better package. Hi, I'm Tom Allen, RIA Advisors Retirement Plan Consultant. Don't assume a 401k plan is too costly or complicated for your small business to offer. Let us show you how to make the most of an affordable and effective plan that will deliver true value for your business and your employees. Call me toll-free at 855-RIA-PLAN or online at realinvestmentadvice.com. That's realinvestmentadvice.com.
And now, another page from the Real Investment Advisors Investing Manifesto. A passive investment portfolio requires active risk management. It's not a choice, it's necessity. Diversification doesn't protect against risk of loss. Let us actively help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
The Real Investment Show.
Welcome back to the Real Investment Show. I'm Danny Ratliff here with Jonathan Penn. We appreciate y'all joining us this Tuesday morning. So, talked a lot about, just questions that we get, things that we see on a day-to-day basis. And one thing I think that you've encountered quite a bit here recently, John, is Roth 401ks versus a Roth IRA. And I'm not really sure that, as a whole, that the financial media does a really good job, or benefits groups, of explaining this and why you would use one over the other. And maybe talk a little bit about some of the challenges that people see with this, or maybe probably more than challenges, misconceptions.
Yeah, I think there's still, there's a lot of education to be done with this. I know we're big fans of the Roth. I know we talk about it a lot. But here lately, I'm getting a lot of questions around, okay, John, wait a minute. What is a Roth 401k? Is that even something that's available to me? How do I find out? And then how is that different from a Roth IRA? And of course, what makes it confusing is, there are a separate set of rules on how you can qualify to possibly make a contribution to a Roth IRA, and can you make a contribution to a Roth 401k? So there's different rules for each, and that always makes it fun and interesting to keep up with this. But basically, with the Roth IRA, money goes in after tax. You don't get a deduction when you put money into a Roth IRA. You're putting money into the Roth IRA with after-tax dollars. It's the same thing with a Roth 401k. With your pre-tax Roth 401k, money goes in pre-tax. You're not taxed on that income. It goes into that 401k plan, then traditional 401k plan, and then later in life, when you either retire, you move away from that business, that money goes into your traditional rollover IRA, or when you use that money, that's when you pay the tax on it, right? Well, with a Roth 401k, you're putting after-tax money in the Roth 401k now, so that way later in life, when you're older, you're retired, you're going to be pulling money out of that account, it comes out tax-free, right? Well, what's confusing between the Roth 401k and the Roth IRA is, with the Roth IRA, depending on if you file single or if you file a joint return, depending on the income that you earn, you may or may not be able to contribute to a Roth IRA. Like, for example, for 2023, if you're a single taxpayer, if you make over $153,000, Well, you, in the eyes of the IRS, you make too much money to make a contribution to a Roth IRA. If you file a joint return for 2023, if your income is over $228,000, no dice. You cannot put money into a Roth IRA. Those amounts increase for 2024. For a single taxpayer in 2024, if your income is over $161,000, you cannot put money into a Roth IRA. For a joint return, if your joint income is greater than $240,000 next year in 2024, you cannot put money into a Roth IRA.
And only to confuse matters more,
Yeah.
you could actually still, maybe if you make a little bit less than those numbers, put in a partial contribution.
Yes.
But now you got to calculate. You got to make sure that you don't put in too much. The IRS frowns upon that. It is not, it's almost, I almost rather them not have that. They say between this amount and this amount,
It's
you
phased.
can contribute. Like you said, what is it? 138 to 153, I think.
Right.
That's where if you're single, you've got that little bit of bandwidth where maybe
There's
you can
a
put
little
some
bit
in.
of wiggle room there.
Yeah.
Yeah. So then I was visiting with a client yesterday who said, now hold on a second. I did check. I have the ability to contribute to a Roth 401k through my employer's plan. And they file a joint return. They're high income earners. And she said, well, I make too much money. I can't put money into the Roth 401k. I said, you guys earn too much. You cannot make a contribution to a Roth IRA. But it doesn't matter how much you earn. If you have the ability to contribute to a Roth 401k through your employer's plan, doesn't matter how much money you make, you can absolutely participate and contribute to the Roth 401k through your plan, through your employer's plan.
Yeah, and I think that's the biggest misconception is that most people hear about the Roth IRAs and they know the income limits on it. And so for a high income earner, it's a little bit foreign that they're able to go put these funds into the Roth 401k. And, many people have always thought, okay, well, you have these conversations. I make too much money. I can't
Right.
contribute to it. But that's not the case. And you actually have a lot more bandwidth where, in a Roth IRA, you can only put up, if you're under 50, you can put $6,500. If you're over 50, you get a catch-up provision. You can do $7,500. You can put in, if you're under 50, into a 401k, $22,500. If you get a catch-up provision that allows you to put up to $30,000 if you're over 50. So you can still do this. Now, I think it's difficult for many because number one, you think that the income limitation is there, right? Number two, if you're a high income earner, we've always been told that we need to put these funds aside pre-tax because we're going to retire in that much lower tax bracket. So it's kind of shifting the way that most people think. And it is really difficult when you start thinking about, well, ideally, I should be spending much less in retirement. So this should make sense because then I would be pulling these funds out at a lower tax bracket. That's just unfortunately not always the case. Not to mention, we could spend a whole nother segment on what's going on in the world, the amount of debt that's out there and how in the world are we going to pay for it. That's a whole nother problem. But that would lead me to believe that having funds and some diversification in other areas that are not all pre-tax is going to be extremely advantageous in the future. And we won't even get into all the back pocket taxes that we talk about from Social Security being taxed, Medicare surcharges,
Your IRMA
for
charges.
premiums, IRMA. Those are little things, but they all add up. So part of this game is about, number one, how do you accumulate? Where do you accumulate to give you more flexibility later in retirement to keep more money in your pocket? And I can't tell you how many people forget about those additional, taxes that they incur because most people don't know about it. It's not talked about. So, it used to be, only a couple of years ago, about half of the 401ks had the ability to go put funds into a Roth. With the new Secure Acts, it's actually 89% in 2022. And so, which I think is great news. I mean, we're moving the needle in the right direction. And it's something that is extremely warranted because how many people have you seen that every dollar they have, outside of maybe a little bit of a savings, is inside the 401k? And while that's great, they retain no flexibility. So, you see people, and we talk about, we call it the retirement smile. You retire, you're going to check off bigger ticket items. You're probably going to spend a little bit more money, bucket list stuff. And all of a sudden they're pulling everything out of the 401k and it's all taxable. Like, whoa, hey, I didn't realize I was going to have to worry about this, but they don't have that flexibility that you would have with that Roth 401k.
That's right. And I was just having lunch with another client couple. It was about 2 weeks ago, and they are great savers. But the issue, and it just when in their quote unquote time of saving, the Roth 401k just wasn't an available option. They just didn't have it. So their main investment vehicle was their pre-tax 401k plan. But the wife made the comment of, I really wish I would have been able to participate more in a Roth 401k, or I wish somebody would have told me about this many, many years ago. I wish I would have been more educated about this, because now, every time they take money out of their traditional, whether if it's property taxes, or they need a new AC unit for their home, or they need to go buy a new vehicle, every time they're taking money out of their IRAs, it's all taxed as ordinary income, right? And the challenge with them is, unfortunately, they don't have a lot of cash that's set aside in an emergency fund that's not an IRA. Their IRAs are their workhorses, right? And that's so it's like the double whammy. They're getting taxed on everything.
Yeah,
right?
Absolutely. Well, and another caveat is that a lot of people talk about, required minimum distributions, right? So right now that's at 73. That's actually going to be changing. And so we continuously see them kind of raise the needle. But we know most people, the average American are using these funds to live on. But with that Roth IRA, you're not going to be required to take RMDs from it, those required minimum distributions, which I'm sure if you have funds out there in an IRA, you're of age, you're probably getting calls from your advisors now saying, hey guys, we haven't taken this distribution. We need to go ahead and do so. Everybody's trying to get ahead of the last minute kind of rush to get that done for those distributions. But that's another nice tool. The other part of this Secure Act is actually, they've changed how people inherit IRAs. Used to be able to take it if you had a non-spousal beneficiary, they could take it over their lifetime. And now there's a 10-year window. And while that's nice to have a little bit of a wiggle room here and some room that you can take these funds out over 10 years, in that Roth IRA, the funds are still not taxable. Whereas in the traditional IRA, your heirs, which may be at their peak earning years, maybe they've done a great job. This is something that at the end of the day, we want our funds to go as far as they can. You've worked hard for them. Find ways to protect them. So this is another avenue that you can do so.
Yeah, it is. And maybe you are retired, or let's say you're and you're not quite of the age where you're having to start taking your required minimum distributions yet. I mean, maybe there's a window there where possibly maybe you have all this money in this traditional or this rollover IRA. Sometimes a conversion, maybe you can convert to a Roth, and there's a lot of rules around Roth conversions, and that's maybe some information for a whole different show. But sometimes it makes sense to, everybody's situation is different. Maybe it makes sense to convert some of that money from a traditional IRA to the Roth now. And who knows what taxes will be in the future. We don't really think income taxes will be any less, right? But maybe you were talking about those non-spousal beneficiary IRAs. Maybe it makes sense to convert some money to the Roth, so that way, heaven forbid, you pass away, leave that money to a child, then that's tax-free. It can be a great estate planning tool.
Yeah,
Possibly.
A fantastic planning tool. I mean, there's so many different things that are out there. We're going to get into more of that this week. But, John, thanks for joining and sharing such valuable information. Hey, if you have any questions, go to realinvestmentadvice.com. If you have not been to YouTube, go to The Real Investment Show. Sign up there. Go subscribe. Hit the like button, please. And if you like what we're saying or doing, share it. So we'll be back tomorrow. Thank you for joining us. Everybody have a great Tuesday. Lance will be back, I don't know, whenever he's done with his extra turkey, when he's back. See y'all.